Welcome back, everyone. We're diving into the fascinating world of investment funds today.
Always a relevant topic.
It is. And, we're going to be looking at this through the lens of Benjamin Graham's The Intelligent Investor. This book, even though it was written back in the 1970s, is still considered like the Bible for a lot of value investors.
Absolutely. It's a classic for a reason.
Yeah, timeless wisdom. And one of the things we'll be exploring is how these investment funds, how do they actually stack up against the overall market? We'll also be uncovering some maybe not so great stories about these things called performance funds, and we'll even see if we can discover some strategies, especially around these closed-end funds, that might give you a bit of an edge.
Sounds like a plan.
So to kick things off, Graham lays out two main types of investment funds: mutual funds, which are sometimes called open-end funds,
Right.
and then these closed-end funds. What's the big difference between these two?
Well, with mutual funds, you can, cash out your shares whenever you want. You get the net asset value. And that's basically you take the total value of all the assets in the fund and you divide it by how many shares there are.
Okay.
But closed-end funds, those have a fixed number of shares. They trade on the stock market, kind of like regular stocks.
Interesting. So closed-end funds are more like a company in a way with a set number of shares out there, whereas mutual funds are more, I guess, fluid, with shares being created or redeemed based on demand.
Exactly. And it's interesting because the investment fund landscape it's just exploded since Graham was writing back then.
Mm,
He was dealing with maybe a few hundred funds at most.
right.
And now we're talking thousands of mutual funds, hundreds of closed-end funds, and then all these exchange-traded funds, the
Yeah.
ETFs.
Right. Right. Which are kind of taking over the world, it seems like. So things have gotten way more complex since Graham's time, but we go back to the basics. What did he discover about how these investment funds actually performed compared to just the whole market, the broad market?
Well, one of the key things, and it might be surprising to some people, is that most of these funds, especially the bigger ones, they kind of just end up performing about average. They track the market.
So even with these professional fund managers making decisions, they're not beating the market consistently.
It's really hard to do that consistently. And it's not necessarily a reflection on the fund managers themselves, right?
Yeah.
It's just that they're managing so much money that their decisions actually kind of end up influencing the market itself.
It's almost like a self-fulfilling prophecy, right? The more professionals are involved in the market, the tougher it becomes to actually beat the market that they're all influencing.
Exactly. And that brings us to this fascinating thing that Graham talked about. He called them performance funds. These were really big in the 1960s. And these funds, they were all about promising investors these much bigger returns, way above what the market was doing.
So those kind of promises that sound a little too good to be true. What was their secret sauce? How are they claiming to get these spectacular results?
Well, they were heavily focused on growth stocks, those newer companies that have the potential to really take off. And they were also trying to capitalize on those market trends, kind of ride the wave of investor enthusiasm.
Right, so a pretty high risk, high reward approach.
Yeah.
Did it pan out? Did they deliver on those promises?
Not consistently. Graham actually tells this really interesting story about the Manhattan Fund. It started in the mid-60s, had a ton of money poured into it, and it did amazing at first, like way better than the market.
Wow.
But then things kind of fell apart.
What happened? Did they make some bad bets?
Yeah, some of their big investments were in companies that actually went bankrupt within a few months. So it just shows how chasing those quick, huge returns can be so risky, and that risk can really come back to bite you.
Yeah, a good reminder that what happened in the past doesn't necessarily tell you what's going to happen in the future.
Right.
But this was back in the 60s, right? Things have changed since then, haven't they?
Well, not really. The performance fund thing, it keeps coming back in different forms. Think about the dot-com bubble, late 90s, early 2000s.
Oh, yeah.
All those internet funds promising the moon, and then boom, they crash and burn. Took a lot of people's money with them.
Oh, yeah. I even remember this young fund manager, Brian Jacob. He was touted as this like a genius, and his internet fund was doing incredibly well. And then, of course, it all came crashing down. It seems like history has a way of repeating itself. But Graham also hints at this idea that closed-end funds, those ones we talked about earlier, that they might actually offer an advantage to investors. What did he mean by that?
Well, unlike those open-end funds, which are usually sold at a premium closed-end funds, they often trade at a discount to their net asset value.
Wait, so you're saying you could potentially buy into a fund for less than what it's actually worth? That's That's pretty interesting.
It is, isn't it? Graham, he gives us a hypothetical example to illustrate this. So imagine two investors. Investor A buys shares in an open-end fund at a 9% premium. Investor B buys shares in a closed-end fund at a 15% discount.
Okay.
Now, let's say both funds perform the same. They get a 30% return on their assets. Investor A, when they cash out, they'll get that full net asset value. But remember, they already lost that 9% premium they paid up front, so they only made 21%.
Right, because they paid more to get in, so their actual profit is lower. What about investor B?
To get that same 21% return, Investor B would only need to sell their closed-end fund shares at a 27% discount. So even if that discount widens a bit, Investor B is still ahead of the game.
Interesting. So there's a built-in cushion there, but are these discounts common? And do they usually stay fairly stable?
Discounts can fluctuate, of course, but historically, they haven't gotten so wide that they wipe out that initial advantage. And sure, some closed-end funds trade at a premium, but even those, even their performance, hasn't really backed up that higher price, according to Graham's research.
Interesting. So closed-end funds definitely sound like something worth looking into. But before we dive deeper into that, let's talk about these things called balanced funds. Now, these funds, they hold a mix of stocks and bonds. What did Graham have to say about those?
Well, back in his day, he wasn't overly impressed. He found that the average income return from balanced funds was lower than what you could get from things like U.S. savings bonds or those higher-rated corporate bonds.
So he thought it was smarter to just manage your bond investments separately, rather than wrapping them up in a balanced fund.
Yeah, that was his thinking. It gives you more control and potentially a better return. But, it's important to remember this was the 1970s.
Right.
The investment world has, well, it's evolved quite a bit since then.
That's true. I mean, interest rates were crazy high back then,
Mhm.
and the whole market landscape was it was different. So Graham's thoughts on those balanced funds back then, they might not apply in the same way today.
Exactly. Things have definitely shifted. We've got to consider the current economic climate
Yeah.
and how that might impact different types of funds. But that core idea behind balanced funds, that diversification thing, that's still as relevant as ever.
Yeah, that mix of stocks and bonds, it's supposed to help smooth out those bumps in the road when the market gets a little rocky, right?
That's the idea. Stocks take a tumble, bonds might hold steady, maybe even gain some value, and that kind of helps stabilize your portfolio. And of course, it can work the other way around too. So even if Graham wasn't totally sold on balanced funds back then, that principle of, balancing risk and return, that's still key today.
It seems like it's all about adapting those core Graham principles to the current market. And we've talked about how those larger funds, they tend to just kind of mirror the market, and it makes it tough to consistently beat the market. But what about smaller funds? Do they have a potential advantage there?
That's a great question. And actually, Graham looked at this when he was analyzing those high-performing performance funds we were talking about earlier. He looked at a group that had some pretty remarkable returns in 1967. We're talking gains of like 84% all the way up to, get this, 301%.
Wow. But could they sustain that?
Well, their overall performance over a 4-year period was decent. Some even beat the market. But it was clear that keeping up that level of outperformance, that's really, really hard to do.
So is there something inherent to smaller funds that might give them an edge, at least in the short run?
There might be. They often have more flexibility. They can invest in more niche areas, or they can take more concentrated positions in certain stocks. And if those bets pay off, well, that can lead to higher returns. But the flip side is, of course, there's higher risk too. And as a fund gets bigger, it gets harder to maintain that kind of nimbleness.
It's kind of like the difference between steering a speedboat versus a giant cruise ship.
Exactly.
Yeah.
The speedboat can zip around, make those quick turns. The cruise ship, well, it needs more space and time to change direction. So yeah, those smaller funds, they might have a shot at outperforming in the short term. But it's super important to remember, past performance is not a guarantee of future results.
Words to live by in the investing world. So, with all this in mind, what are some key takeaways investors should, really take to heart from Graham's work when they're trying to navigate this whole complex world of investment funds?
One of the biggest things is to be a discerning investor. Don't just jump on the bandwagon because something is labeled as a performance fund or promises to make you rich quickly. Instead, really focus on understanding the fundamentals of the funds you're considering.
So do your homework. Go beyond the marketing hype. Look at their strategies. See what their long-term track record looks like. What kinds of fees are involved.
Exactly. And don't forget about your own risk tolerance. What are your investment goals? There's no one-size-fits-all answer when it comes to investing in funds. The key is to find the ones that align with your own situation and those long-term goals you have. And Graham's wisdom, it's timeless. His focus on value investing, focusing on the intrinsic worth rather than just chasing trends, that can really help you weather those inevitable ups and downs of the market.
Excellent advice. And we've covered a lot in this deep dive. Different types of funds, the dangers of chasing performance, that potential upside of those closed-end funds, how those balanced funds might have evolved over time. It's been a fascinating look into Graham's insights and how they can apply to investors today. But before we wrap up, there's one more important aspect of investing in funds that we should touch on, and that's fees.
Ah, yes, those pesky fees. They can really sneak up on you, often overlooked, but they can make a big difference in your returns over time.
Absolutely. We talked about sales loads earlier, but there are all sorts of other fees that come with funds, aren't there?
Oh, yeah, there are. You've got your management fees, expense ratios, 12b-1 fees, sometimes even hidden costs. It can feel like a jungle of financial jargon out there.
And why are fees so important? Even if they seem small, can they be negligible over time?
Even those seemingly small percentages, when they compound over years or even decades, they can eat into your returns in a big way. Think of it like a slow leak in a tire. It might not seem like much at first, but eventually it can leave you stranded.
That's a good analogy. So how can investors be more savvy about fees when they're choosing funds? What should they be on the lookout for?
First and foremost, read that prospectus. I know it's like reading the fine print of a contract, but it's got all the details about fees. Pay attention to the expense ratio. That tells you what percentage of the fund's assets are being used to cover those operating costs.
So lower is better when it comes to expense ratios, generally speaking.
Usually, yes. Lower cost funds tend to do better over the long haul. But don't just fixate on that expense ratio. Look at the fund's performance history, their strategy. Sometimes a slightly higher expense ratio might be justified if the fund has a really solid track record.
So it's all about finding that sweet spot
Yeah,
between those fees and the actual performance.
exactly. And don't be afraid to ask questions. If something in that prospectus isn't clear or you're not sure about a fee, reach out to the fund company or talk to a financial advisor. Knowledge is power when it comes to investing.
Well said. Knowing what you're paying for and how it can affect your returns, that's crucial. So to recap, when you're looking at investment funds, don't get caught up in chasing performance. Really dig into that fund's strategy, the fees involved, their track record, and always remember those core Graham principles of value investing.
Couldn't agree more. And here's a final thought for you to consider. Think about how Graham's insights on those performance funds and market cycles can help you navigate those inevitable hype cycles that are sure to come in the future. How can you, as an intelligent investor, avoid getting swept up in all the frenzy and instead make those smart decisions that align with your long-term financial goals?
That's a great question to ponder. Thanks for joining us on this deep dive into the world of investment funds. Now let's shift gears a bit and talk about one more important concept that Graham emphasized, the difference between investment and speculation.
That's a key distinction, especially when we're talking about funds. It's easy to get caught up in the market's excitement, especially when you hear stories about funds raking in those incredible returns. But as we've been discussing, chasing performance can be a risky game.
It really can. So how can we apply this idea of investment versus speculation to the world of funds? How can we determine if a fund is truly investing or just playing the speculation game?
It all starts with understanding the fund strategy, their investment philosophy. Does the fund manager have a well-defined and consistent approach? Are they genuinely focused on building value over the long term? Or are they more about trying to time the market and ride those short-term waves?
Yeah.
What are the criteria for picking investments? These are all vital questions to ask.
It's like giving a car a thorough inspection before you buy it. You want to make sure the engine is solid and it's been well maintained, not just impressed by the fancy paint job.
Precisely. Just like you wouldn't buy a car solely based on its appearance, you shouldn't choose a fund just because of its past performance. Look under the hood, understand those underlying principles, and make sure they align with your own investment approach.
So if a fund is super concentrated in a few popular sectors, or if it seems like they're always chasing the latest hot trends, that's a potential red flag, right?
It could be. It doesn't necessarily mean it's a bad investment, but it might mean they're taking on more risk trying to snag those higher returns. And remember, those higher returns often come with more volatility and a greater chance of losing money.
Right. So as investors, we need to be aware of those risks and make sure we're okay with the level of risk a particular fund is taking on.
Exactly. And this is where Graham's concept of margin of safety comes in. He believed in buying assets at a price significantly below their intrinsic value, creating a buffer against those potential losses.
Now, that makes sense when you're talking about individual stocks, but
Mhm.
how does that apply to investment funds? How can we assess whether a fund is offering that margin of safety?
It's not as simple as valuing a single stock, but there are things you can look for. For instance, if a fund is trading at a big discount to its net asset value, that might signal a margin of safety. Also, if the fund manager has a history of investing in undervalued companies, that's a good sign.
So it really comes down to doing our homework, understanding the fund's strategy, evaluating those risks, and looking for those hints of a margin of safety. It seems like there's a lot to consider when it comes to choosing investment funds.
There is, but that's what makes it so engaging. And remember, investing is a marathon, not a sprint. Taking the time to make those well-informed decisions based on sound principles can make all the difference over the long haul.
Well said. And on that note, I think it's time to wrap up our deep dive into the world of investment funds. We've learned so much from Benjamin Graham's timeless wisdom, and I hope you feel better equipped to navigate this complex landscape with a renewed sense of confidence.
I agree. Remember, the goal is to be an intelligent investor, not a speculator. Focus on value, manage that risk, and always keep those Graham principles at the forefront of your mind.
Thanks for joining us on this journey, and until next time, happy investing.
It is a lot to think about.
hmm
But that's what makes it so interesting. Being an intelligent investor means weighing your options and really understanding those risks so you can make choices that fit your own goals. And Graham, he really gives us a framework to work with.
He does, and we've covered a lot, haven't we? The different types of funds, the whole performance chasing trap. We talked about those closed-end funds and their potential, even touched on those fees and how Graham's principles are still so relevant today. But before we wrap things up, there's one more gem from Graham that I want to make sure we highlight. He talks a lot about the difference between investment and speculation.
Ah, yes. Crucial distinction, especially in the world of funds.
It is.
It's easy to get caught up in all the buzz, all those stories about funds making those huge returns. But as we've seen, chasing performance can be dangerous.
Right, like jumping on the latest trend without really thinking about if it's right for you.
Exactly. For Graham, real investing had to be rooted in a solid understanding of a company's intrinsic value, their assets, their ability to earn money, their long-term potential. Speculation, on the other hand, that's driven by those short-term market swings, often fueled by emotions and following the crowd.
So how do we apply that to funds? How do we know if a fund is truly investing or just speculating?
Well, you've got to look at their strategy, their whole philosophy on investing. Does the fund manager have a clear, consistent approach? Are they focused on building value over the long term, or are they more interested in trying to time the market? What are their criteria for choosing investments? Asking those kinds of questions can be really revealing.
It's like checking a car's engine before you buy it. You want to make sure it's in good shape, not just focus on how shiny the paint is.
Exactly. You wouldn't buy a car just because of how it looks, and you shouldn't choose a fund just because of its past performance. Look deeper, understand those underlying principles, and make sure they fit with your own investment philosophy.
So if a fund is really heavy in just a few hot sectors, or if they're always chasing the latest fad, that's a red flag.
It could be, might mean they're taking on more risk to get those high returns. And remember, high returns often come with more volatility and a higher chance of losing money.
So as investors, we've got to be aware of that and make sure we're comfortable with the level of risk a fund is taking.
Absolutely. And that's where Graham's margin of safety comes in. He was all about buying things at a price much lower than their real value, creating a buffer against potential losses.
Makes sense for stocks, but how does that work with funds? How can we tell if a fund has that margin of safety?
Well, it's not as simple as valuing a single stock, but there are some clues. If a fund's trading at a significant discount to its net asset value, that could be a sign. If the manager has a good track record of investing in undervalued companies, that's another plus.
So it comes down to doing our research, understanding the fund's strategy, looking at those risks, and searching for signs of that margin of safety. A lot to consider.
It is. But that's the beauty of it. And remember, investing is a marathon, not a sprint. Taking your time, making those well-informed decisions based on solid principles like Graham's, that's what makes a difference over the long term.
Couldn't agree more. Well, I think we've covered a lot of ground in this deep dive into investment funds, all through the lens of Benjamin Graham's wisdom. I hope you're feeling more confident about navigating this world and that you have a better understanding of how these principles can help you reach your financial goals.
We too. The key is to be an intelligent investor, not a speculator. Keep your eye on value, manage those risks, and never forget those Graham principles.
Thanks for joining us on this journey. And until next time, happy investing.